Okay, thank you all for joining us today. We're gonna get started here in just a second. So I wanted to thank you all for joining us today on this episode of On the Mark. Have a very, very special guest today, the one and only reverse mortgage queen of the world, the one and only Janice Cohen. Janice, thank you so much for joining me on this call today.
It's such a pleasure to be here, Mark. Thanks for inviting me.
Absolutely. There is nobody else I wanted to be in this conversation with. So I'm really glad you're here, and I know people will learn a lot from you. So um so we got a lot to cover today. The question is to reverse or not to reverse. And I think the broad picture here is that there are times when seniors need a reverse mortgage, and there are times when they need something else, and that's what we're here to clarify is what are the right situations, what are the right circumstances that seniors may need this type of support, and which one of us should they be calling, basically, is the takeaway from today. So Janice, maybe tell the audience a little bit about yourself. I know all about you and I'm a big fan, but let's make sure everybody else can be a big fan too. So tell us all about you. How did you get into reverse? What's your background? Just to let people know who you are.
Well, I've been doing reverse mortgages now for 20 years, which blows my mind when I kind of quantify it that way. But I started with my career with Wells Fargo 20 years ago. I like to say I knew nothing about mortgages 20 years ago, aside from the fact that I had one, and it needed to be paid every month. Other than that, I knew nothing. And maybe that worked to my benefit because I didn't have any sort of obstacles, preconceived notions about mortgage lending. I just went straight into reverse at Wells Fargo. It was a pretty steep learning curve, as you can imagine. At the time, I was in New Jersey, and which is, I kind of claim citizenship in both New York and New Jersey. And of course, now I've lived in California for the past 15 years. So I think I'm staying in California based on the weather. I love it here, and I know you do too, Mark. So my career has taken me from the major lenders, Wells Fargo, subsequently MetLife for a period of time. And now I've been with Mutual of Omaha for the past 10 years, and it's been wonderful. It's a terrific company to work for, and we're constantly innovating and improving on our processes and trying to be absolutely the best company in the reverse mortgage space. And we are accomplishing that every day. So I'm
Right.
very happy.
Yeah, well, I appreciate that. And how did you get into the reverse side in particular? Very curious.
Well, I had a next door neighbor who had reinvented himself, and I was looking to reinvent myself at 20 years ago. And I went and had a conversation with him, and I said, "Hey, Bob, do you think I would be a good loan officer?" He was a loan officer with Wells Fargo, and he had been an engineer. And I guess he just wanted a change. And he said, there is a new division at Wells Fargo, and I want to introduce you to the manager there because you're a teacher, you're an educator, and this field of reverse mortgage, which is quite different than traditional lending, requires a lot of patience and requires maybe different strategies to help people learn what it is that you're trying to teach them, because we want people to have a really good understanding of the reverse mortgage program. So it does require a little more, finesse, a little more hand holding, a little more pedagogy than traditional lending, where people are, we're concerning ourselves with kind of different issues, different sides of the same coin. And I went for my interview with Jim Gallagher over at Wells Fargo, and he offered me the job on the spot, and I thought, this guy doesn't know what he's doing. I know nothing. And I went home, and I think I burst into tears because I realized like I was taking on something that I knew nothing about. But, as most of us do, we kind of jump in with both feet and kind of fake it till you make it. And here I am 20 years later, a top producer for Mutual of Omaha. So it worked out okay.
Yeah. Well, good. Jim obviously had a good eye because
Yes.
he knew a star when he saw it. It was just need a little polishing at the beginning.
Mm, yes.
But I'm proud to have you in my network, and I know you're a great resource. And I'm in the same boat. I really like the type of lending that requires advice and understanding. And we're not financial advisors by trade, but we look at things through that same lens, and that's what I always appreciate about you. And I try to carry myself in the same way because especially when you're dealing with seniors, you are dealing with different issues. You're dealing with tax implications. You're worried about, you know, medical needs and things that, when you're buying your first home, you're not really thinking about those things. You're thinking about maybe school districts, which is
Yes.
different, than thinking about care and legacy and all these other things. So that's why I enjoy the space. I got into it somewhat on a whim as well. It started out as a bridge loan program for me, that expanded on a somewhat national scale, and then that leaned into the senior space for a relocation company that was specifically in the senior space. And then from there, it opened my eyes to all the needs that seniors have, and we've expanded tons of new products that are really conducive to the needs of seniors. And also, one of the challenges, as you know, for seniors, qualifying for traditional financing is really difficult because they're not working anymore, right? If you've moved in, for example, to an assisted living facility, you're not running a business out of a home office anymore. It's just not how it works. So yeah, I really enjoy this space, and it feels good when you help a family, and that's what I enjoy about it most. But so let's go into some of the details about reverse mortgages, because I think there's a lot of misconceptions and misunderstandings, and people have really strong opinions about them one way or the other sometimes. But maybe you can talk about just, what is a reverse mortgage? How do the mechanics work? And then we'll get into what the different types are as well.
Okay. So a reverse mortgage is a tax-free strategy to access home equity, a portion of the home equity. A lot of people, when they call me, they think that they are selling their home to me, and that is not at all what we do. And so, for instance, if their home is worth $800,000, they may believe when they're dialing the phone to call me that I'm going to be able to lend them $800,000, and certainly not, because this is simply a mortgage. And we are going to lend them a portion of their home equity. We're going to lend them a portion of the value of their home. And the value of their home, let's say, for instance, if their home value, as I said earlier, is 800,000, and let's say they're eligible to borrow, for instance, 50% of the value of their home, that might be a typical scenario. However, I have several different types of borrowers who can borrow 50% of their $800,000 home. Some of them may owe $400,000 on a current mortgage. So with that $400 or 50% that we're able to lend them, we're going to have to pay off their existing mortgage. Now that's going to free up a lot of their monthly income and make their lives much more sustainable. For some of them, they don't have a mortgage, and opening up $400,000 of borrowable money could translate into monthly income. Maybe they're going to need monthly income for a period of time, maybe 10 years. So we'll be able to put them on a monthly income program that will help them get through the next 10 years. Sometimes a person wants even a higher measure of security from their monthly income program. So we may look at lifetime income, however long that might last, which is another program, might give them a little less monthly income than the 10-year program, but it'll give them security. No matter what happens, I'm always going to be getting this monthly income. And then some people may say, I don't need monthly income. I just want to know that I have a line of credit available to me in case of an emergency because I don't have a safety net. So what would a safety net be? A safety net could be long-term care insurance that they do not have. It could be investment assets that they do not have or no longer have. They could maybe say, I want to see how long I can survive on just Social Security income. And sometimes people will say, I just want to check this out. I want to see how long I can go on Social Security income. And then I'll get a call 3 months later. Okay, I needed a new transmission for my car. So Social Security alone is not going to make it, but I really only need an extra $300 a month. So we can do that. We can give them $300 a month and the balance will be in a line of credit. It's so flexible that not only can we start them off on a program that can change in the future, we should look periodically at how they are utilizing the reverse mortgage and see, is this still working for you? Would you prefer a little extra money? And I'm always available to my clients
Yeah.
to have that conversation.
And would that necessitate a refinance of the loan if they wanted, like, say they were getting monthly payments, but now they want to do a line of credit, for example? You have to redo the whole loan or you just modify the existing one?
We can just modify the payment plan with the servicer, and we service most of our own loans. So it's very easy to make a modification and there's no need to do a refinance. And we're able to make the modification, then we see how that new payment plan or income plan is working for them. And if we need to make further changes in the future, we can do that.
Yeah. Well, it sounds like it is pretty flexible, which is good because seniors oftentimes, as you said, plan for one thing and then something else happens. They plan to stay in the home, then they need to go into care facility or vice versa. They really want to stay at home. And that seems like the type of situation that's probably more appropriate for a reverse, which we'll get into a little bit later. But so you mentioned there's lots of different types. Seems like it's very flexible to kind of structure thing around what the senior needs, what their financial needs are, upcoming expenses, a new radiator, a new transmission, all those things. What is it? What are the typical, okay, let's put a timestamp on this. We're talking April 30th, 2025. What are the approximate interest rates and what does it cost to obtain a reverse mortgage?
Okay, so I feel like I need to kind of say at the outset, there are several types of reverse mortgages. The most commonly understood and the most commonly discussed is the FHA reverse mortgage. And when you're talking about the majority of the United States, we're talking about an FHA reverse mortgage because very often it works best for homes that are 1.2 million in value and lower. And so an FHA reverse mortgage, you're looking at rates in the sixes, so not an outrageous interest rate. What makes an FHA reverse mortgage a little different are the upfront closing costs. And these are, by the way, these costs are rolled into the financing. But there is an upfront mortgage insurance premium that goes directly to the Federal Housing Administration. And we are going to see that upfront insurance. It's 2% of the appraised value of the home. So if the home appraises for $1 million, that upfront mortgage insurance premium is going to be $20,000. And people will say, wow, that's a lot of money. And indeed, it is a lot of money. I don't want to minimize it or make it seem as though, this isn't a valid concern. But what are you getting for that insurance? I think this is important. The insurance is what makes the FHA reverse mortgage a non-recourse loan. So, Mark, you and I understand what it means to have a negatively amortizing loan. And so what that is, of course, is a growing loan balance because no payments are expected or required on a reverse mortgage. So the balance, instead of reducing each month like your mortgage and my mortgage, because we're far too young to have reverse mortgages.
Oh,
um
yes. It's not gray hair growing on this one.
yeah. We are making payments on our mortgages each month that's going to reduce our balance. Well, on a reverse mortgage, a borrower could make payments on their reverse mortgage, but very few do, because most of the time they need to utilize those loan proceeds for whatever was the concern that they had in the future that led them to do a reverse mortgage.
Right.
So very often, most of the time, it is a negatively amortizing loan. So what that means is, over decades, there is a change in the equity that's remaining in the home. Now, if the home value is growing at the same rate that borrowed money is being charged interest, that wouldn't be much of a problem, right? I mean, that would mean that you're going to have just as much equity in the home at the end of, say, 20 years as you did when you did the reverse mortgage in the first place. But let's say that all of a sudden the value of the home took a really big dip, which, happens periodically. I bought my home in 2011 at practically the bottom of the market. I had no way of knowing that it was the bottom of the market. But when I looked at my house and the realtor said to me, hey, this house was listed for a lot more money 6 months ago. And I said, yeah, right. That's a good strategy to try to sell this house. But when I went online and looked, I saw that indeed this house had been worth a lot more at some time in the past. So there are times when real estate values take a dip and interest rates, they pause for no one, right? Interest is going to still be charged on that outstanding loan balance. So even if my home were to drop in value by 25%, my loan isn't dropping in value by 25%. So there could be a period where there's an even greater reduction in home equity. And if a person lives a long enough life, depending on a variety of circumstances, there is the potential, depending on the usability of the proceeds of the loan, where there could be maybe little or no equity left in the house. And what's special is that the heirs or the beneficiaries will never have to worry about bringing money to the transaction to get out of the loan that their parents did or that their spouse did. I know when I bought my very first house in Philadelphia, I was in graduate school in Philly. We bought a house for, very little money. And by the time we were leaving Philadelphia, when graduate school was over and we were ready to move on, I had to bring a check for about $1,500 because my loan balance was higher than my property value. So I didn't have a non-recourse loan.
Right.
And so
And just to explain to the group, non-recourse basically means that you're not personally guaranteeing that balance. It's
Correct.
so there's nothing the bank can do to capture on that if you're short.
Exactly. And it's really amazing. In fact, I had a woman when I was first doing reverse mortgages in New Jersey. I had a woman call me. She was one of the very first loans that I did. And so maybe it was 2006. And she called me last year. She said, I don't know if you remember me, but I am now 95 years old and I've never even touched my reverse mortgage. So the balance on my line of credit has grown to triple what it was. Not the balance that she owes, but the balance that she can borrow. And we'll get to this in a moment too. She said, I can now borrow way more than what my house is worth. And I need care in my home. What should I do? And I said, Gertrude, take out the money and use it to pay for your care in your home. Because whatever happens, if you live another 10 years, if you live another 5 years, even though you're taking out more money right now than your house is actually worth, no one will ever come after you and no one will ever come after your beneficiaries. So that's what she did. And she was able to stay in her home. Her nephew managed her care. They had plenty of money to be able to care for Gertrude in her home.
Yeah, and that's always one of the biggest challenges, I'm sure, when both of us are navigating these options for seniors is how long can I make the money last to pay for care, but also am I going to have to sacrifice the quality of care or the place that I want to receive that care, whether it be at home or in some other type of place. And that's the thing you really like that gives me a lot of you know, it just feels good when you help a family figure that out and know that they can afford what they want to do and use the equity to their advantage. And also, what I've found, and maybe you've seen this as well, is that most seniors that are aging right now are what I call a buy and hold generation where they bought their homes decades ago. And obviously it's not for everyone, but a high percentage of people bought their homes many, many, many years ago and now have seen that appreciation go through the roof. I mean, even in some places, even 10 years, your property's doubled or tripled in value in some areas. So, but the difficult thing is navigating the care expense because, and we've done a lot of podcasting about this and interviewing people in the senior space, and there's just the cost just seem to get higher and higher and higher. And home care, from what I've heard, can cost up to $30,000 a month if you need
Yes.
full-time care. So like that can drain the accounts pretty quickly. And you also have times when, like we're in right now, where all of a sudden the stock market dipped 15% out of nowhere, and people don't want to liquidate their investment accounts because they're at diminished values. So, and also if you liquidate, you have potential capital gains issues and other things. So I'm a big proponent of financing your way through these things as well. And I know there's lots of different ways to do it, but um, so let's talk a little bit about the criteria for qualifying. Like, is there an age minimum for some of these programs? Do you have to meet a certain credit score? Like how stringent are the underwriting criteria?
So what we look at, generally speaking, is we look at the Social Security income primarily. I have borrowers who are still working, and I have borrowers who easily qualify just based on Social Security income alone. We do look at credit, but really more to determine what may need to be an ongoing monthly payment on a credit card, a leased car. We don't want to set someone up for failure. We really, truly want to make sure that when this person has completed their reverse mortgage, that they're in a position poised for success. And we take a lot of pains to make that happen. So it's interesting. Many times we do a history, we look at a history of the, what has a person, how have they been paying their property taxes? Let's say the house is paid off. They've been paying their property taxes out of pocket, looks good. They're on time every month. They're paying their homeowner's insurance every quarter, every twice a year, looks good. They own other properties perhaps, and they're on time with their insurance and property tax payments for those properties. Maybe there are mortgages, they've been on time. So a person like that in our underwriting process is going to be able to receive maximum proceeds. And we will not have to do what is commonly referred to as an impound account, but in reverse mortgage terminology, we wouldn't have to do what we call a life expectancy set aside. So if a person comes to me and we see there have been habitual late payments on their property taxes, and there have been lapses in their homeowner's insurance coverage, and maybe late payments on credit cards or charge-offs, or even that they have such a high debt load and their Social Security income alone is not really sufficient to pay all of their household expenses, we will say to that person, okay, we are going to calculate what will be your property taxes and your homeowner's insurance going forward. And by the way, this also applies to homeowners association dues for condos. So we'll look at all of these payment histories and we'll say, okay, we've noticed a couple of lates. Can you explain these lates? And sometimes they'll say, oh, well, that was the month that my wife passed away and I was on another planet mentally. I mean, I couldn't, I completely forgot that taxes were even due. And okay, then a person like that, that is a one-shot situation. We get it. But if a person says, sometimes I just forget to pay the taxes. Okay, that happens too. I've actually forgotten to pay my taxes once or twice.
Right.
It
We
happens.
all need a personal manager to remember everything we've all got to do.
Exactly. We have a lot of bills to pay. So it for a person like that who says, Janice, I just forgot. That's not considered an extenuating circumstance where we can override that impound account,
Right.
you
And
know?
that's probably pretty common because you're dealing with aging adults and memory issues are coming into play for many of them. Or they may be in the hospital for a month and all of normally they would have paid the bills, but they're not home to pay them physically.
Exactly. And if they can demonstrate that they actually were in the hospital, we can override that life expectancy set aside. But if it's like, I forgot, I do sometimes forget these things, then we have the delicate conversation. Hey, would it be helpful for you to not have to worry about that ever again? And to know that your taxes and your homeowner's insurance were being paid by our company and you never had to think about it again? Oh yeah, that actually would be good. I'd feel good about that. Okay, let's look at that. And that can work very well.
Yeah, if you're simplifying things for people that, especially as they're aging and if they're managing their own finances and not relying on maybe one of their adult children who are oftentimes involved in these decisions as well. Are there any restrictions on what you can use the proceeds for? Like if you wanted to pay off a debt or you wanted to buy a new car or you wanted to, buy at least a Lamborghini and ride off into the sunset. Are there guardrails on what you can use that money for?
There are not guardrails. A person, we don't infantilize our borrowers. They are adults. And as long as they're competent, this money can be used for whatever purpose they deem necessary and or desirable. Um, it's interesting because I added the proviso that if they're competent. I once had the son of a borrower come to me and ask for a reverse mortgage for his father. And that happens all the time. And the vast majority, like 99.99% of the time, we notice and we've documented that bills are being paid by the son or daughter, everything's looking responsible, everybody's really doing the right thing. But for this particular person, I asked for bank statements, and I noticed that they were co-signers on this checking account. And then I noticed that all of Dad's Social Security money was going to online gambling.
Mm.
And I said, okay, I didn't tip anything off. I said, we're going to have to get this approved by our underwriter. And I submitted everything, knowing full well that it was going to be a little bit of an issue. And in the end, we ended up submitting a suspicious activity report because we believed, and rightfully so, that this son was milking his father for every penny and gambling it away, which is a very, very sad state of affairs for the entire family.
Sure. Yeah, and you don't want to exacerbate that by then giving them access to hundreds of thousands of dollars that could vanish in a bad night. When the
Exactly.
house wins. You don't want to lose to the house when you're giving away your house.
Right. And the
Uh,
house always wins.
yeah, for sure. And then at what point does the reverse mortgage need to be paid off? Like what would trigger that?
Well, if it's a married couple, it's when the second member of the couple passes away and leaves the house permanently. We like to think that our borrowers will always be able to manage living on their own, but we know that there may come a time when they can no longer care for themselves and can no longer afford to pay for care. Also, if they are paying for property taxes and homeowners insurance themselves, and the property taxes are not being paid, and homeowners insurance is not being paid, that can also make a loan due and payable. We also have a requirement that our borrowers send back to us every year an occupancy affidavit saying, yes, I'm still living in the home. Everything's fine. Sign my name, send it in. If they don't send in the occupancy affidavit, which sometimes they forget, or sometimes they think it's just junk mail, but it's actually very important. But if
Yeah.
it doesn't come to us and we subsequently cannot reach the borrower, that could create a default situation. But in those types of situations where it's just a matter of the occupancy affidavit not being returned, we can usually rectify it by calling on whoever is the secondary contact, which we collect with every application. We say, who's the backup person here? And let's get that person's name, address, email, phone. So
And hopefully it's not the gambling son, right?
no, hopefully, well, yeah,
You stop
definitely,
that one in its tracks, but
for
yeah,
sure.
that's not the person you want to list as your secondary person.
Right.
So you mentioned occupancy. So what I imagine you're alluding to is that you have to continue living in the property while you maintain this loan. So if you were to move into assisted living, for example, or and then maybe you rent the house or not, but you're just not living there anymore, that would require a repayment of the loan.
Correct. So mind you, I have plenty of borrowers who call me and say, Janice, I broke my hip and I'm going to be in rehab for 3 months. Is my loan due and payable? And the answer is no. The loan is not due and payable. You can go to rehab, you can get healthy again and return to the house. That's not going to be a problem. There are you cannot, however, rent out your home. Um, I this is something I was in conversation with a woman who considers herself a free spirit. She wants to travel, but she has a home in Los Angeles that she could rent out for probably $10,000 a month, no exaggeration. And we both know people who have properties like this. And she said, I really want to do the reverse, but I want to have a stream of income so that when I'm in the south of France for 6 months, I can rent out my home. And I said, well, then this probably is not the right fit for you right
Right.
now.
Call this guy.
Call this guy.
And that's
Exactly.
why we're here, right?
Yes.
For sure. And okay, and one last thing just about the mechanics is um when there's a situation, and now I'm forgetting my question, but um okay, we're gonna move on to the next question. It's been a long day. Woke me up really early. Okay, so then how do you help people decide, like what are the criteria you usually use to help them decide if a reverse mortgage is the right thing, if they think, let's say their plans might change in a few years. And lastly, the question came back to me is it, do you, in your opinion, is it best used for a long-term approach, short-term approach? Are there some advantages or disadvantages if you hold the loan for a longer period of time versus a shorter period of time? Not talking about bridge loans. We'll talk about that separately, but a
So
couple
these are
years versus 20 years, let's say.
right. So these are great questions. I had a call, in fact, from a prospect a few weeks ago. You and I had a conversation about this person. She said, my mom really can't stay in the house anymore, but the house needs upgrades. We need to get the house in saleable condition because we want to sell it within 6 months. And we want to do the reverse mortgage so that we can access funds to renovate the kitchen and the bathrooms. And I said, no, this is not a reverse mortgage. This is a bridge loan. You're going to need to do a loan that's designed for a short-term solution. A reverse mortgage is not really designed for that. It's designed for a long-term plan. Now, does it ever happen that I do a reverse mortgage for someone and then a year later they are either not able to stay in the house anymore or they pass away? Yeah, I mean that definitely happens. But it's still for certain people a better option, especially if they don't know that they're not going to be able to stay in the home. But if it's a short-term solution, or if the home is not suitable for FHA lending. I have had clients call me. We've actually gone under application. I've sent out an appraiser. The appraiser comes back and says, are you aware, Janice, that there are all kinds of unpermitted areas of this home? And I was never told that. I didn't know that. That's going to be a problem for us. So that's maybe a better fit for someone like you, Mark, who can find
Maybe.
maybe you can find something for them much more easily than I can. I am a by the book kind of lender. Everything has to, the stars have to align in
Right.
many ways for a reverse mortgage to go through.
Yeah. And I think one of the things that I wanted to just cover real quick about the long-term nature of these loans is that, and I think one of the reasons why people have a slight aversion to them, and again, some people are very for them, some people very against, but I'm neither here nor there. I think they serve a purpose in the right circumstances, which is why we're talking today. But is the kind of compounding loss of equity, at least theoretically, depending on what happens to the property value, but assuming the property value stays constant, which it never does, but let's just assume in a perfect world, for our conversation, it does. If you're not making payments, let's just say, and the balance is accruing, is it true that you're kind of accruing interest on interest? And then as you go further, you're losing equity at a faster pace if you're in that loan for longer?
Yes, that is true.
Okay.
Interest is compounding. So we know this. And we talk about, every single one of my clients and their advisors get an amortization table that we look at together. So we can see the mechanics over the course of a lifetime. So this is a very interesting question. And it is true that over the lifetime of the loan, depending on the balance and the growth on that balance, that the balance will begin to grow at a faster rate. But I want to share the flip side of compounding with you. And that is for the type of borrower who comes to me and owes nothing at the moment on their home. And they say, I don't have long-term care insurance. I just want a line of credit in case of emergencies. I think I alluded a little bit earlier to the fact that a reverse mortgage line of credit is growing each year at the very same rate that borrowed money is charged interest. So, depending on the utilization of the reverse mortgage proceeds, this can work to the advantage of a borrower. I have seen it where a person begins their reverse mortgage with a line of credit of $300,000. After 10 years of not touching it, they now have $700,000 to borrow. And for someone who does not have long-term care insurance, that is powerful. And it is peace of mind, because why would a person do this instead of getting long-term care insurance? Because they're not insurable. As we go through life, as we get older, as we get a diagnosis, whether it's diabetes or a type of cancer or any kind of chronic medical condition, you may not be insurable and you may not be able to get long-term care insurance, even once you have figured out that it is, in fact, a good idea, which we
Right.
know, but
Yeah.
not
Yes, and I've
everyone is.
interviewed people in the LTC world as well, and most people just either don't know that type of insurance exists or they just never come across it, and so they just don't have it. And then when they go to actually apply, it's too late
It's
because
too
they don't
late.
qualify. And then yeah, they're in that situation. So okay,
Absolutely.
so you've given a very thorough review. I always learn a lot from these conversations, and it sounds like, to be honest, they're much more flexible than I even knew. So I appreciate you sharing all those insights, and I can talk a little bit about the alternatives to reverse mortgages because I think oftentimes people think senior mortgage, call Janice, right? Call Janice for the reverse. But there are some situations that we kind of alluded to that may not be the right situation, or it may just be another alternative to look at to see which one is the right fit for your particular needs. And we'll go through some of the circumstances, and maybe both of us can kind of talk through the nuances of that. But just to give a quick overview of some of the alternatives. So you mentioned bridge loans. So when a senior needs money short term, whether it be to, if they're moving into a senior living community, for example, and there's an entry fee or there's a certain number of months of upfront rent and they need to pull out equity for a short term until they sell their home, or they need to renovate, as you were alluding to earlier, or they just need to cover their expenses for a short period of time. There are bridge loans that are designed to allow seniors and others to be able to borrow that money on a short-term basis. And it's known upfront. So you said like you could try to do a reverse mortgage, but that's not what they're designed for. You really need a bridge loan. Bridge loans, it's very well known to the lender that that's what you're doing. It's baked into the terms of that loan. So we do a fair amount of bridge loans to try to help seniors navigate this process, but that's obviously not the type of loan you want if you need long-term funds, right? If you're going to stay in your home and you need to pay for hopefully not, but maybe $30,000 a month, that's going to run up quickly. So some of the other options that we have would be to actually cash out a lump sum of money. And hopefully, knock on wood, I see some people who are attending today, some great financial advisors that I know well. The idea is if you pull out a lump sum and then you invest it, you can offset the interest cost if you're investing it wisely. And obviously that's where the financial advisor comes in, is to, try to help them navigate that. But the key to any type of financing for seniors is the ability to do loans that are not based on income or not exclusively based on income, that can be based on other sources or different mechanisms. So some of those might include, we have a loan called asset depletion, or asset dissipation, where if you have a certain amount of assets in the bank, but you don't want to use them, or they're caught in a retirement account, or you're in a situation like we are in right now where the stock market just, dropped by 15% unexpectedly. There are ways to pull out equity from the home to as an alternative to, potentially triggering a taxable event by liquidating. And then, also use that money to invest over time to help kind of hedge the cost of the interest. And one of the alternatives and the conversations that we often have is that's a potential way to offset the compounding if we're going neck to neck to see who that client wants to use. It's a way that we talk to people about not giving away equity on that compounding basis. But sorry, I don't know if you had a comment. I didn't want to cut you off there.
You spoke a little bit about market volatility in as it relates to asset dissipation. And you know what I've been experiencing in the past several weeks, since there's been bumpiness in the market, is that people who have a few $100,000 invested in the market, they don't want to touch it right now because they're afraid, if they take it out while the market's down, that is depleting their assets at a much greater rate than if they were to take out money when the market is up. So we have actually a strategy for people to use reverse mortgage for monthly income during a bear market and to use their assets under management during a bull market. That keeps them in much better financial health.
Right. Yeah, and this is what you and I were talking about earlier about the advisory nature of what we do. Like you have to understand the tax implications of what you're suggesting to a client.
Yeah.
That's what separates the really good mortgage advisors, whether it be on the reverse side or others, from the ones who just quote rates for a living and they could care less if your client is, about to trigger a huge taxable event. And you hope that seniors have financial advisors, but they're also a kind of a do-it-yourself generation. I think they didn't grow up with financial advisors being such a thing and knowing as helpful as they actually are. So that's definitely something we try to get families to understand is don't try to do this on your own. It can be you can make really bad decisions. Capital gains is a huge deal for seniors.
Absolutely.
And we've seen people that say, maybe a reverse isn't right for them because they're planning to move into assisted living. And they're like, well, I got to figure out how to pay for this. Right. So what they do is they go and they sell their home, but that could trigger a huge capital gains tax event. We had a client, actually, it wasn't a client. It was somebody that we met in the senior living space who told us a story saying, God, I wish I knew you 3 months ago. It was a senior who bought a home for $30,000. It was now worth 4 million.
Yeah.
And she needed money for care. She was 97, but she needed money for care. So her family unknowingly probably didn't have proper advisors guiding them, said, oh, okay, let's just sell the house. We got $4 million coming our way almost, minus the costs. And what they didn't realize was that they were going to pay capital gains based on the original acquisition price, which meant that they probably wrote between state and federal taxes, probably $1 million check to the IRS. Had we spoken to that client, we could have instead borrowed the money to pay for the care. And instead of writing $1 million check to the IRS, they give that money to their heirs, which I'm sure they would strongly prefer.
I'm doing a loan right now because of the long-term capital gains implications. This is a home in Beverly Hills. It appraised for $10 million. And yeah, if they bought it in 1970 for 200,000. So you can just imagine what they would have to pay.
Yeah, and the
Um,
IRS isn't going to return that check out of the goodness of their heart once you write it. You're they're going to keep it. And we're not advising tax evasion. We're advising tax strategy, and that's an important piece for seniors in particular because they've owned their homes for so long. On average, they have a lot of equity built up, and therefore a huge capital gains tax potentially. But if they have proper advisors, then they'll know about these things. But I felt so bad for that family who I never met, but just knowing that they wrote that check to the IRS and it could have been avoided if they just knew what the options were. But there's a lot of other really cool products. There's one like if somebody wants to purchase a home, there's something called a family opportunity loan, which allows like the children to buy the home for the parents and still treat
wow.
it as a primary residence, as long as they can show that the parent either isn't physically or financially able to make that purchase on their own. That's a really like hidden gem.
Mhm.
Sometimes we have just the adult children co-signing if they're open to that idea. And that would be like, hey, let's talk to an estate attorney as well to see how to structure this in a way that when the family member passes away, that's part of the strategy of who's on title and whatnot.
Mhm.
And then there are some loans that just don't require any statement of employment or income. So if you're a senior, you have to be, of sound mind to be able to sign documents on your own behalf. But if you maybe don't have children or somebody that can help you, there are loans that you can take out that will allow you to use the funds as you wish, and you can cash out a lump sum and then hopefully invest it properly to offset the interest. So there are loans that are a good fit for seniors. They're not necessarily senior loans, but they're guidelines that allow us to help seniors through their most common challenges, which is typically income for the most part. And then as you get further down the path of life, when, incapacity is more of an issue, or maybe it's even, the property and the estate is being handled by a trustee, or maybe if after they pass away, it's in probate, we can also do loans where you can pull equity out, also non-recourse, to be able to pull out equity to help settle that estate or to
Mhm.
give money to the heirs if they've rushed to go buy a house that they weren't actually ready to buy yet, which is the most common one that we get. But I want to be mindful of time. So I want to go through, okay, when do we call Janice? When do we call Mark? And when do we not pick up the phone for anything? Um, Not enough money to pay for care. Correct me if I'm wrong.
That-
Definitely call Janice. If you're going
That's a
to stay
Janice
in the
call.
home,
Yeah.
you're going to stay in the home, call Janice, but maybe call Mark also. We'll make that one a tie.
Okay.
Maybe other alternatives to look at, but that is definitely in Janice's wheelhouse for sure. Preferring to age at home. Yes,
That's a me.
I
Yep.
would generally agree. Moving into assisted living or memory care.
That's Mark.
That's me. Exactly, because of the owner occupancy requirement. Avoiding capital gains of selling the home or liquidating investments, but still wanting to move out of the home or
If they're
needing.
moving, they're calling Mark.
Exactly. The owner occupancy is a big important factor for reverse that we learned about from you today. Okay, this is a tricky one. Mental capacity to sign. If the senior lacks mental capacity to sign on their own, can you do a loan for them? Can you do a reverse mortgage for them?
I can actually, have, if they can sign, or if they have a power of attorney, or if they are conserved, any or all of those situations will work for a reverse mortgage. As long as we have, now this is surprises a lot of people. When we get a power of attorney, when we see a power of attorney, number one, it has to be seasoned, has to be at least 6 months old. Because if you're coming to me and saying, last week my mother was competent and this week she's not, and she signed her POA last week, if something happened, like she had a stroke or something that makes sense, then yes, we would still be able to do the reverse. But powers of attorney, we need documentation that the borrower was competent when they signed their documents. So yeah.
Yeah, that's tricky. And on my side, that's a tough one because banks are very cautious about seniors being taken advantage of. So on any cash out transaction where you have a power of attorney, a lot of banks won't allow it because they're so fearful that the senior's being taken advantage of. So
Interesting.
what it usually requires is maybe a loan to a trust. If there's a trust, you can do like a non-recourse loan to the trust where the trustee is signing on their behalf and has the rights to do so in the trust agreement. Or, conservatorship if they have someone who can legally document that they're allowed to sign. But you're talking about expensive loans. These are not, your typical underwriting and interest rates and fees. So
Mhm.
that is definitely something that's probably a better fit for Janice. One member of the household still resides in the home while the other does not. Could be either way. I mean, it definitely
Either
works for
way.
you. Definitely
It
works.
works for me. I've done loans with an ineligible non-borrowing spouse. They're still married, separated, other other spouse has their own apartment, their driver's license has the name, their address on it, and we look at a couple of utility bills and we can say, okay, we're not going to include you as a borrower.
Right.
Yeah.
Okay. What about where your family members, adult children, want to own the home after you pass away?
I would say that's more Mark.
I think so too.
Yeah.
Yeah, our requirement doesn't survive the loan process, meaning you don't have to maintain a property as your primary residence for more than, your intended first 12 months of ownership. That's usually the requirement.
Hmm.
Intending to live in the property for 12 months, you can get a primary residence loan, but then you can turn it into an investment property or, leave it vacant or whatever you want to do after the fact. Um, you want I think this probably applies to both, but you want to have your investment account last as long as possible.
Well, we already touched upon using a reverse mortgage strategically, whether it's a bear market or a bull market. And Mark, I'm sure you can also help if someone says, I need to get through this year of volatility. I just don't want to take out any more money. You can help them with that too.
Yep, exactly. In lots of different forms. So I think that one, we'll call that one a draw. Family wants to rent the property to pay for care or other expenses.
That's a mark.
The mark,
Yeah.
correct. What about financing for a home purchase? Can you do a reverse mortgage to purchase a home?
You can. It's there are limitations because we're not lending as much as you would be able to lend. But then again, if we were to each underwrite a borrower who wants to purchase a house using a mortgage that we would offer, uh, it might be a draw. We
Right.
might be able to help equally. It's not going to be 80% of the purchase price for a senior who's living on Social Security, but who
Right.
knows? That would be something interesting for us to look at.
I would say that's call both.
Yes,
Or
yes,
let's get on a Zoom together and we'll collaborate and help the family figure it out. That's what I always prefer.
yeah.
Great. And short-term situations, you already covered that one with the story that you gave about people looking to just renovate the home. So that one we've already covered. Bridge loans, I'll take that one.
Mhm.
Um, but anyway, Janice, I think we've covered a ton today, and I just want to thank you so much for being a valued member of my community and somebody that I turn to when I have questions or clients have questions. And my hope is that the audience will turn to you just like I do. Janice is an expert, don't let the 20 years that she mentioned that it took her to get to this point fool you. She was an expert on day two.
Oh,
Um, but I do see a raised hand and I see some questions coming in. So bear with me 1 second. Okay, so we'll go through the questions first. Rick from Pasadena. Hi, Rick. Nice to see you. I think we both know you well. Interested in better understanding the credit availability access once the reverse is in place.
well, When I do a reverse mortgage for a borrower, they would be able to log in to their account online, and they would be able to access the transfer or request the transfer of funds into an account which they had previously set up at the time of the funding of their loan. And here's something interesting. If the home is in a trust, the bank account into which they're transferring funds must also be a trust account. A lot of people, they have their home in a trust and they say, I want the money just to go into my checking account. I get that, but we need to match up the account ownership to the home ownership. So if the house is in a trust, the account into which you're channeling money also must be in the trust.
Got it. Okay. Stephanie from New York City. Hello, Stephanie. There's two Stephanies for New York City, so I'm going to go with the question from one of them first. In May 2022, reverse mortgage became possible for New York City co-ops. Do you know
Mhm.
anyone who are players in the co-op reverse mortgage space? That's a
I
tough.
do, Stephanie. If you would want to give me, send me an email or a message, Mark can provide you with my cell phone number and my email, and I will hook you up. I will be able to help with that.
And
We do not do the uh, reverses for co-ops at Mutual of Omaha. So
got it. All right, I'm going to share my screen that actually has Janice's information now that we're in the Q&A. Um, so, okay, we have a few questions from another Stephanie, also a fantastic financial advisor in New York. Um, do reverse mortgages make sense if there's very little equity in the current quote unquote regular mortgage?
there should be at least 50% equity in the home if you're looking at a reverse mortgage. If there is an existing mortgage for 80% of the value of the home, it probably is not going to work, unfortunately. And yes, I do practice in Illinois.
There you
So
go.
feel free to call me for Illinois.
I
And
highly recommend it. Yes, I can connect the two of you privately if you'd like.
Mhm.
And what's the look back period for the bill payment history that you were discussing earlier?
2 years.
2 years. Okay, so if they haven't been paying their taxes for a
Mm.
couple years or their bills in general, that could be something you
Yeah.
have to work around.
Or if they got caught up at some point,
Mhm.
but 2 years has passed and now they have 2 years of a perfect history, then we'll be fine.
Okay. And next question, will a homeowner be automatically disqualified if they have little equity and outstanding HELOC loan as well?
Yeah, again, it's going to be we need about 50% equity in the home for the reverse mortgage to make sense. And Stephanie, I can certainly send you I can send you some really beautifully designed um, information that will help you be able to uh, digest all of these reverse mortgage facts or even share them with your clients.
Right. And Stephanie was also asking a question, what are the interest rates pegged to for reverse mortgages?
Great question. So it's pegged to the 1 year treasury, the CMT. And we have the CMT plus a margin that we use for in order to calculate the interest on a reverse mortgage. And Stephanie, I'm going to take a picture of your phone number right here, and we
I've
will.
got it. I've got it saved in
Great.
my phone, so I can also share it, no problem.
Okay.
Sounds good. Well, those are all the questions that I see. Let me just see if anybody else has added anything new. Lots of thank you comments, so it's absolutely our pleasure. And I think that wraps it up for today. So Janice, thank you again for sharing your insights. Yeah, like I said, it's always great to partner with you, and I know you come from a good place of service, and those are the types of people I love to surround myself with. So thank you so much. And
Thank you, Mark. This was wonderful, and I just always enjoy our collaboration.
absolutely. Likewise. Well, we'll see. We'll be seeing each other lots, I'm sure. around town. But if anybody has any questions, our contact information is on the screen. You know where to find us, and we will be sending out a recording of today's session for anybody who couldn't attend live. And like I said, we're always here to serve. So give Janice a call, give myself a call. Even if we can't help you, we can usually point you in the right direction. So thank you all for joining, and we will see you again next time. Take care.
Thanks so much.
Bye bye.